Welcome back to the Neuro Finance Masterclass. So, for the past few weeks, we've been deep in the abstract world of stocks, digital assets, things you can't really touch. Today, we're shifting gears. We're coming back to something tangible, something you can literally hold in your hand. We're talking about physical commodities, and specifically, the big one, the asset that has anchored economies for millennia, gold.
I mean, just think about this for a second. For 5,000 years, gold has been the ultimate survivor. Empires have risen from the dust and crumbled back into it. Entire currencies, printed by governments that swore they'd last forever, have collapsed into worthless paper. Stock markets have crashed spectacularly, and through all of that chaos, gold has held its ground. It has consistently maintained its purchasing power. It's wild to think that an ounce of gold could buy you a fine tailored suit in ancient Rome, and, well, it can still buy you a really nice tailored suit today. It's the one true constant in our very chaotic financial history.
But this incredible, long history is exactly what leads to what I call the great misunderstanding. See, most amateur investors, they look at gold's track record, and they buy it for completely the wrong reason. They expect it to make them fabulously wealthy, like the next hot tech stock. And that, right there, is a fundamental and often costly error in thinking. We need to unpack why. So what is the mathematical error here? Why doesn't gold behave like a stock or a piece of investment property? Why doesn't it just go up and to the right forever? Well, to get to the answer, first we have to get really clear on what gold is not.
Okay, so the assets we typically use to build our wealth, we call those productive assets. Think about a stock in a tech company, right? That's not just a ticker symbol. It's an ownership stake in a real business full of smart people who are actively inventing new products and generating real profits. Or think about a real estate investment trust, a REIT. It owns actual buildings that collect rent checks every single month. The point is, these assets are working for you. They are actively creating new value, and that's what allows them to compound over time.
Now look at this contrast. It's night and day. A bar of gold, what does it do? It just sits in a vault. That's it. It doesn't invent a new gadget. It doesn't build anything. It doesn't pay you rent, and it absolutely does not pay you a dividend. If you take 1 ounce of gold and you stick it in a safe for 100 years, guess what you'll find when you come back? Exactly 1 ounce of gold. It's passive, it's stable, it doesn't compound because its purpose is something else entirely.
Which, of course, leads to the obvious question, right? If this thing doesn't grow, if it doesn't create wealth, then why on earth would a sophisticated investor, an architect of their own financial future, even bother with it? What is its real job in a modern portfolio?
And here it is. This is the whole ballgame, the crucial point that so many people miss. Gold is not an investment you make for growth. Gold is an insurance policy. Its job isn't to make you rich. Its job is to make sure you're never poor. It's there to protect everything else you've built.
Gold is the ultimate store of value. This is what that really means. When everything else goes horribly wrong, I'm talking a major stock market crash, I'm talking runaway inflation, I'm talking about some kind of geopolitical panic that spooks everyone, that's when gold has its moment. All that institutional capital, all that smart money, it flees from risky assets, and where does it go? It flows into gold. It is the ultimate hedge against a total systemic collapse.
So how do we actually use this insurance? Well, a neurofinance investor, a true architect, might keep somewhere between 5% and 10% of their total portfolio in physical gold or maybe a gold ETF. Now let me be crystal clear about this. That little slice of the pie, it is not there to make you rich. It is there to ensure that you never, ever go completely broke. The other 90%, that's for building your wealth. This 10%, this is for preserving it.
Okay, so this brings us to your cognitive task for today. I want you to go look at your own portfolio, and I want you to mentally, or better yet, on a piece of paper, separate every single thing you own into 2 distinct piles. Pile 1, wealth creation. Pile 2, wealth preservation. Genuinely mastering this distinction in your own mind is one of the biggest leaps you can make towards becoming a truly sophisticated investor.
I love this analogy. Think about it this way. To build a skyscraper, you need steel beams, you need concrete, you need glass. That's the stuff of creation. Now, insurance policies are absolutely critical to protect that skyscraper once it's built, right? But you can't build the structure out of the insurance papers themselves. It's impossible. Assets have different jobs.
So let's wrap it all up with this. This is the crucial takeaway. I want you to write this fundamental rule down somewhere you can see it. Commit it to memory. I buy stocks to build my empire. I buy gold to defend it. That right there, that is the essential difference between creating wealth and preserving it for generations to come.